Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, August 19th, 5:32 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world-famous 21 over 21 list. Let's jump right into it. State of the market. We are in an uptrend. We're seeing this uptrend challenged for the first time, though, as the 4-week win streak in the S&P and the Nasdaq came to a halt this week. We ran into the overhead declining 200-day moving average on the S&P, and basically to the dollar, it reversed there. And we had a second day of a pullback, then a nice tight inside consolidation day on Thursday. Made it look like we were gearing up for another run at the 200-day moving average, but an expectation breaker today as we broke down to lows for the week. We'll take a look at the charts momentarily, but you can see over here on leaders, still flashing bullish uptrend, but 7 of our leaders came off the list this week, meaning they either broke down and are still below their 21, meaning they broke their expectations, or they broke their 21-day exponential moving average and needed to be replaced with something better. So the sub arrow pointing toward neutral now. Let's see if we can gather things together next week and make a stand at the 21 in the indexes and see if the leaders can hold things up. Still a lot of stocks acting very well. I had easily 40 to pick from for the 21 over 21 list. So all hope is not lost. Let's go to the short-term moving average. All the indexes still trending above their respective 21-day short-term exponential moving average and above their medium-term 50-day moving average. Long-term, we poked three or four of the indexes poked their heads above the 200-day moving average. Actually, 3 of them poked their heads above and had a couple of closes above the 200-day moving average this week. But what's important is how the week ends when you're talking about the long-term moving average, and they all broke back below. So the green sub arrow trying to get us off a bearish downtrend could not get it done. So still sitting there under the 200-day moving average for all the indexes. So what happened today, as I mentioned, S&P 500 and NASDAQ 100 broke their 4-week up streak. During that 4-week up streak, the small cap, mid cap, and Dow had just barely down for the week during that streak before continuing higher last week, but that definitely came to an end this week. And even worse is that it was led lower by growth stocks across the board. Small and mid cap were the worst on the week, but relative to the S&P, but growth underperformed value. It's not what we want to see in an uptrend. So the G6 on the day down 2.5%, S&P 500 down 1.3%, NASDAQ 100 down about 2%, Dow down a little less than 1%, mid caps down 1.6%, Russell down 2.2%. Global diversified 60/40 stock bond down 1.1%. In-house, our GROTECTION portfolio gave back yesterday's 1+% gains. We were down 1.34% approximately on the day. Let's get to the tail of the tape, and let's get to a little description of what we do here at Revere. If you're not familiar with us, we want to make ourselves widely known because we think we've got an extremely important service to provide to investors, especially people approaching retirement. I'm going to bring in the chart that I tuck under my pillow at night. Last 13 bear markets to remind me how important it is to protect capital. Nobody wants to get hit with one of these highlighted severe bear markets as you're approaching retirement. On average, the last 6 severe bear markets have lost 44.5%. That means you need an 80% gain to get back to even. January to July so far, we don't know if it's over. We know we lost 24.5% at the peak, which means we needed 32% to get back to even. We got about half of that back and then ran into the 200-day moving average. Now I'll go over to this chart and explain. Ideally, it's this area that you see back last November. We want to see the indexes and leading stocks trending above their short-term green line 21-day, medium-term red line 50-day, long-term black line 200-day. All is well with the markets. You can sleep tightly when things are going well like that. Even pie chart people can sleep tightly, but I start to get a little bit restless when we start breaking below these short-term and medium-term moving averages. We back off when that happens, and if we really break down as we did starting in January below the short and intermediate term and pierce this long-term black line, that's when that's when risk is highest, absolutely at its highest. Every bear market and even the severe bear markets, you reach that 20% once you're below the black line, the 200-day moving average. Usually from peak to breaking it is about a 12% drawdown. That's very tolerable, but once you get below there, you saw the numbers. You don't know how low you can go. This looks bad. It's nowhere near as bad as 2008 was, or 2000 was, or COVID was, but pretty bad. Then we start to step back in when we move off the bottom and get below or get back above these short-term moving averages and medium-term moving averages, and we participated nicely in this run up. Our SSO position that we put on in July, right here, July 15th, has 20% gains before we ran into the 200-day moving average, pulling back a little bit now. We have a hedge on against that gain. And if you think this approach makes sense, what else in your life, when things start going wrong, don't you take corrective action on? Well, why should your finances be any different? Because Wall Street is, I'll tell you why, because Wall Street is a living, breathing conflict of interest. They only make money if you stay in their funds. So they tell you to think long term and really don't care at all when you're retiring or how much you think you need. But if you think, if you're with us and you think that there's a better approach and you'd like to give us a shout, give us an email or call us. Email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. Let's bring up the tail of the tape now and dig a little bit deeper into the indexes. And I'm going to leave stochastics on because I want you to be cognizant of something that we're seeing a whole lot of, and that's this rollover in stochastics. You can trend for weeks above here, but when you start rolling over and you break below this 80 area, let's take a look at the last couple of times it happened. How about here? Big sell-off. How about here? Very harsh sell-off. How about here? Very harsh sell-off. Does it mean it's going to happen? No, it can fake you out the way it did right here, break below and get right back above, and we certainly hope that happens next week if you're a bull, but we're always weighing all the evidence. We want to put the odds in our favor, and when it's time to get defensive, it's time to get defensive. Don't worry about tax implications. You can either give the money to the tax man or just give it back to the market or hedge to keep that from happening. We've got plans for everything, all scenarios, bullish, bearish, neutral. We got them covered. We got rules for it here at Revere, and we'd be happy to discuss them with anybody. We talk about them 5 nights a week on these videos and in our weekly podcast that we do. Make sure you tune into that this weekend as our newest addition to the staff, Michael Ramos, does a nice dive into the natural gas sector. So rolling over in stochastics, ran into resistance at the 200-day. We're below the 200-day. We're still above the short-term and medium-term. We certainly still have exposure on, but we backed it off a little bit today. Let's go to the tail of the tape here. Same headwinds as always. VIX actually closed at 21, not 19. Let me update that. The put call, thank you, pause button. The put call closed at 1.03. First time it's been over 1 in recent memory, so anxiety clicking up a little bit there. VIX above, I said 21, it's at 2060, up 5% today, as certainly some fear crept into the market. So still operating under the bull case in 727, but definitely some chinks in the armor now. So news, Bitcoin and Ethereum broke down hard a little after midnight Eastern time. And that hit the indexes. It's just kind of seen as a risk on a risk-on signal. It moves a lot in conjunction with the NASDAQ, and when it broke down, the indexes were on set for a lower open. Also got some horrible German inflation data overnight. As I mentioned, the win streak snapped. So today was OPEX, a little bit more volatility than normal. The dollar, UUP, I talked about this negative divergence a couple weeks ago and how we were concerned that when we were starting to head up and the index is heading down, it's not a good combination. Well, the dollar just made 5-week highs, and that coincided with, look at the move in the dollar this week, and that coincided with the indexes going lower on the week. So that inverse correlation certainly is still intact. Also the NASI hooked down from overbought. That's the McClellan Summation Index. We'll talk about that a little bit more next week, but it's another reason. It's very similar to what you see on this stochastic on the S&P 500, virtually identical. It stays overbought, and it rolled over, it hooked over for the first time in a while, and that can be a big headwind for the market also. Expectations coming into today was for continued bullish or sideways action after the 810 breakout. Expectation breaker as we close below the ADMA for the first time since back on 726 when we had the first pullback of this rally. So this is the first pullback. Here's the second. This is the third now. We hope the third time is not a charm for the bears, but as I said, we're prepared for everything. We've got our stops in place. From an emotion standpoint, exercising patience with holdings. I have been with longs, but I closed SARK too early yesterday. This is the inverse arc. My initial plan was to hold it for on the break of the 21 on ARK. Maybe this is hindsight talking, but ARK, ARKK gapped down this morning and would have had some nice gains if we'd have continued to hold a piece of that. Really didn't have to sell it all out. So not perfect on emotions all the time, but in this case, and again, like I said, maybe it's hindsight, but would have liked to have been holding that into the gap down this morning. Support and resistance areas coming into today. We pulled down, but the gap down continued lower, closed at this 4230 support. NASDAQ 100 broke through S2 here, and we closed at this. This is a very key fib area here, this 32.54 area where we hit that and closed just about right on it. Let's go through the rest of the indexes before I finish up the tail of the tape. First, we'll go to the NASDAQ 100. Notice how it didn't get to the 200-day moving average. Notice how the stochastic on the daily chart is breaking down. Same story as we showed on the S&P 500. It could be a head fake like it was back here, or it could be something more serious. We've got to be ready for it. Maybe we bounce right at the 21-day moving average since it's its first visit in a couple of weeks. That's certainly a very key level for next week is the 21-day moving average on all of the indexes. We put the red flag up, the red caution warning in the trend gauge last Friday on the 12th when we closed 4.8% above the 21. That's historically extended, and that coincided with the big reversal here at the 21-day, I'm sorry, at the 200-day moving average. Now we're just 1.7% above the 21-day moving average. So there's our key risk area for the next week, and that also coincides with this 810 breakout above this consolidation area. So two levels of support coming into play there next week that we need to pay attention to. The bottom of that being 41.77. We're at this 42.30. That's a key fib area also. When we review the levels, we'll talk about that. So what was strong today? The only one of the sectors that finished positive was healthcare. Relative strength in staples and utilities. Those are very clearly defensive sectors. Bonds got hit, which means rates are higher. And the recent winning sectors, solar and biotech. Here's TAN. That doesn't look so bad, but some of the individual holdings were down mid-single digits today, and Enphase looks to have stalled, but really we're just to the back of this breakout area above the 21, looking for a bounce next week. But notice the three high-volume selling bars in the ETF over the last 5 sessions. And let's go to biotech XBI. Certainly another leading sector. After this breakout here, 86.41, we closed right around 86 and below the 21, so couldn't stay above the declining 200-day moving average. This looks a little bit like the S&P 500. Also, the stochastic has rolled over there also. So those recent leading sectors taking a break. Let's look at semiconductors. Sitting right on the 21, did not break higher the way the NASDAQ did over the past week. So a little bit of a negative bearish divergence there. You can see here's the relative strength line. When it got up as high as price did, the relative strength line did not. That's a negative divergence. SOX software, let's look at IGV, sitting on its 21 after a pullback. XME, XRT, and ITB. XRT was the darling early in the week with the wonderful Walmart news, but 3 days gave up all the gains and then some, still above the 21-day exponential moving average. A lot of things pulling back into the 21. We have to keep an eye on that this week to see what sectors hold and what doesn't. Here's one that didn't held. Went from relative strength to relative weakness over the last 3 weeks. That's home builders, closed below the 21-day moving average this week. So portfolio changes today. First, when we gap down and then continued lower, I put this SDS hedge back on. So we've got half of our long SSO position with 20% gains hedged. We'll keep that in place until we see a serious breakdown, and then we'll end up either putting a full hedge on or taking profits on the SSO position. We sold Amazon because frankly, it just started underperforming. It did what we wanted it to do after its gap up. We're seeing a lot of stalled gaps higher on a bunch of the charts that I look at. So here we had a real nice gap up on volume. It continued higher and continued to show relative strength, but that paused on 8.4, ran into the 200-day moving average and failed, just like the S&P did this week. Now rolled over, relative strength going lower for 2 weeks. This looks fine from a chart perspective, lagging, and we just sold it out at break even, a little bit above break even, still above the 21, but also the stochastic rolled over there too. Add it all up, we didn't want to see the position, which had about a 3% gain, go red, so we sold that. We did add to Wolf. We took 2 buys on it yesterday. This approached, this was acting great midday, making another run toward positive on the day. We added another 2%. It pulled off a little bit. We're still profitable on this, and this, even though the volume was higher today, nowhere near the massive volume that we saw on this yesterday. Keeping a close eye on this as a potential leader if the market wants to cooperate. We trimmed 3 things that we added to end phase yesterday when it looked like it was trying to break out, but it reversed. We took a 4% loss, actually a 5% loss on this 2% add position that we put on. Just not wanting to give anything back when the market is weakening a little bit. So we bought it yesterday, sold it today. Also sold half of GFS and MPWR. The charts look fine. Relative strength looks okay. But we're down like 3% on it and just decided to trim a little bit. Note, it's been staying in overbought, but it looks like it wants to hook down. And if it breaks the 61, we'll be out the remaining small position that we have. And same thing for MPWR. The consolidation looks just fine. The relative strength doesn't. I would have liked it to see it continue higher. It is a long cup and handle, may just be putting in the handle part of the base, could go on for a little while. I think it's a leader. I love the fundamentals, and I'm certainly keeping an eye on it, but we sold half of our position in that too. And the net on that is we took our exposure from a volatility adjusted beta of 1.4 down to right about 1. So market volatility approximately, our volatility now is about even with the market, our beta about even with the market. So bottom line, growth leads indexes lower for the week, 4-week up streak snapped. Let's take a look at support and resistance for next week. We're right on this 42.20 28 to 32 area. This is a 50% retracement of the decline, the COVID the decline from this year. Retraced half of it and stalled, so got back above it, pulled back a little bit, and it's a key level. We have battled around this area for a while, and something to pay attention to. above 4,300. We were rejected multiple times there this week, so that's the key level to get back above next week is 4,300, and we certainly need to hold 4,200. This also is where the 150-day moving average is, right below this 4,230-ish area, and then the next level down is also the COVID rally drawdown of 23%. So lots of area of support next week at 4,200. If we pull back a little bit, that's less than 1%. A lot of support there. If that fails, the 21-day is going to fail and will be very close to cash very quickly. So that is going to wrap up the tail of the tape. Let's get into the 21 over 21 list. First of all, the 7 stocks that got booted off this week. Let's show them. We're going to start with GTLB. This had been a leader, trending higher for a while, has earnings coming up in 3 weeks, but got above the 200 and just couldn't hold it and closed below the 21 also. Tesla, still above the 21, but this is not the way you want to give back gains. 4 days of selling below average volume, but broke below the 200-day moving average. It should have held this. We're still above the 21. I've still got an alert set in case volume comes back into the stock and into the market. The fundamentals continue to be very good, but took it off the list for now. Amazon, I already mentioned how we sold that, so we took that come off the 21 over 21 list. DHI, home builder, ITB broke the 21. DHI, a big component of that, breaking the 21 also. Bros, a massive disappointment since its gap up on earnings, just has continued to sell down, broke the 21 this week. Let's see what else. Silvergate, I sold this early in the week. Glad I did when Bitcoin stalled at 25. Bitcoin broke down today, and SI broke below the 21 today. The couple of sells that we made this week are looking good. We also sold net, and that continued lower. A lot of stocks, just as I said, giving up their gains from their gaps higher, breaking below the low of the gap day, and doing some selling on increased volume recently. Net is still on the 21 over 21 list, but only because it's holding the bottom of this gap up for now. Let's see what else. Roblox is the last, is the 7th stock that came off RBLX. And nice reaction to earnings, positive reversal, made a higher high, but just couldn't go anywhere. Started selling off as growth had a difficult week. Let's quantify the bad week for growth. Here's SPYG. This is the growth half of the S&P. Let's bring it to a weekly chart. That was down 1.9% on the week. SPYV value only down 0.45% on the week. So the combined index itself down about 1.2, 1.3%. Let's get the correct number for the week. S&P 500 on the week down 1.2%. We were down in-house about 0.98% or so for the week. So let's take a look at the weekly underperformance from higher beta things. Here's the QQQ down 2.3% for the week. Here's IWO, the growth half of the Russell 2000. That was down 3% for the week, while IWN, the value part, down 2.65. So small caps underperformed across the board relative to their bigger cap brethren this week. So did I get all of the 7? 1, 2, 3, 4, 5, 6, 7. I did. Let's go to the 7 that we added this week now in our 21 over 21 list. I know the world's been waiting with bated breath to see this list, and now it's time to deliver it. So these are the first 7 are going to be the additions. If they've got a flag next to them, we own them. We bought BJ's yesterday. Nice inside day today relative to yesterday. Held up pretty well relative to the market, just down 0.4%. Needs to hold the low of the gap up day. We only have a small 2% starter position in this. GFS, I mentioned how we still own it. But we did sell half of our initial position for about a 3% loss. Wolf, we added this, made 3 buys on this, going to keep a tight leash on it, needs to continue to underperform, or sorry, needs to continue to outperform after this big gap higher. ANET, this thing has just been trending higher. This should have been on the list for a while ago after the way it acted after earnings, but it's really just been acting perfectly. You're not too late on it though. It's just putting in the right side of this double bottom base. CEG, clean energy stock, putting in a really nice flag here after this big gap up on earnings. This is how you want to see them all act. This is how I'd love to see Wolf act, but this is not how Net acted or how Amazon acted or how TTD acted or how several other stocks that we bought on gaps acted. They just gave it back. Bros is another one. This is how you want it to act, and it just didn't. So if you don't, you gotta move along. Oxy, more news today. We've owned this stock in the past, but we didn't own it. Nice cup and handle breakout on news that Warren Buffett was given permission to buy up to half of the company, up 10% on the day on big volume, 200% above average. And Vertex, the last of the 7 that was added. Really nice action here. I have a feeling medical stocks might start showing some relative strength like they did back here while the market was coming down, and then it started to make a recovery, but growth didn't recover right away, but money flowed right into medical stocks. Then we went sideways a little bit, sold off, a little bit of a resurgence now over the last 2 weeks. After earnings, this has pulled back right to the 21. This is near the top of the buy list if we want to put more money to work. Cloudflare, as I said, not acting the way we want it to, but still holding the 21. And Chipotle has been a nice winner. Again, here's the gap up. This is how you want them to act. That looks beautiful. CDNS continues to look okay, but it did pull back this week along with the rest of growth. Pretty much rest of all the growth stocks break in below the 8, still above the 21, right at its pivot after its cup and handle breakout. Celsius going tight sideways after this gap up in earnings, holding the 21. This one you definitely want to keep an eye on to see the strength of the overall growth market. If this needs to hold the 21, if growth stocks are going to continue to hold up. CNC, another medical stock, medical managed care. This group looking like it wants to make another resurgence. Humana and UNH also look really good in this group. PWR trending higher this week and showing relative strength. AMT, a little bit of a 4-day flag here after trying to make a new high. MPWR, I mentioned we sold half of this, but this still looks great, forming the handle in its cup. On Semi, one of the strongest stocks in the market, one of our larger positions, broke out above this long flat base. Nice pullback on lower volume today. This is acting perfectly, but this breakout needs to hold if the market. This one will be another sign for how the market holds up. Enphase, as I said, solar's wanting to take a break. Finally broke down below the ADMA. We sold the little piece that we added yesterday when it tried to break above 300 for a small loss. Apple pulling back to the ADMA. That's another sign for the market that needs to hold the ADMA. Lantheus Holdings going very tight sideways. No selling whatsoever in this one, but I don't want to see it break down hard below today's lows. We've got double-digit gains in this one. SWAV continues. Again, this is how you want them to act after they gap up. Continues higher, went into 300, little 2-day pullback. We have a 4% half position in this one. And finally, LNG, we have a 6% position in this since the breakout. Fantastic relative strength. Make sure you tune into the podcast to listen to Michael's breakdown of the 3 streams in the whole natural gas extraction, transportation, and delivery process. And that is going to wrap it. As always, love to hear from you. Email me, don@revereasset.com, phone 855-REAL-WEALTH. That's 855-732-5932. So don't forget, this is why this chart here is why we protect our clients' downside. We've had nice gains off of the lows. We're coming into the 21-day moving average. We ran into resistance, and it's time for the bulls to make a stand next week. If not, we'll be getting extremely defensive in a hurry. So wrapping up the week ending 8/19, this is Don Vandenbord with Just the Facts. Thanks for listening. Have a great weekend. We will see you next week.